So good evening, everyone, and welcome to tonight's webinar. For those of you that are new joiners and for those of you that have been with us for a while, I'd like to draw your attention to the disclaimer on screen that I'll read for you now. All information that is provided during this seminar is for educational purposes only. The presenter is not a financial or investment advisor and is not authorised to provide recommendations on any new instrument of any kind as part of this presentation. The strategies showcased are applied on hypothetical scenarios. Any instruments that are mentioned throughout are cited only for illustrative and educational purposes. The webinar is not intended to be a personal recommendation and must not be construed as advice from the presenter. Pepperstone doesn't represent that the material provided here is accurate, current or complete, and therefore shouldn't be relied upon as such. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any listeners of this content to seek their own advice. So thank you for joining us this evening. Tonight's webinar is called Mastering the Divergence. So as you see, we see the structure on screen. We thought it'd be good tonight with what's going on in Europe. There would be a great opportunity for Maurice to talk about how the lockdowns in Europe has hit or potentially could hit all markets, and that's stocks, commodities and currencies. Following on from that, Richard is going to highlight how you can use charts to highlight divergence and how then you can use these indicators to trade the markets. He's going to hand over to Roger, who's going to discuss one of the most important things that any trader has to deal with, and that's handle losses. Okay, so I'll pass over to Maurice. Maurice, over to you.
Hey, Chris, thanks very much and welcome everybody. Yeah, another busy week, last week and this week. For those of you that were with us on Sunday, we highlighted there was going to be potential volatility, which looks like it could spill into the end of the month, which is also end of quarter. So a lot to get through tonight, and I think you know, with the limited time we've got, we'll go straight onto it. Now, one of the things that has been a common factor for us here that we try to get across to you is the potential underperformance from the euro because of the lack of activity from the EU leadership on many situations. So we've got weak politics in a crisis yet again coming to the fore. So I've written some things down here for you to sort of read through whilst I'm chatting about this. I'm going to pick a couple of points out for you, but you know, this really has been one of the most poorly handled crises that the ECB's gone into, and they've been left wanting, to be honest. And I think there is a danger here that with this typical EU leadership blame game and everything else, that there's a lot of credibility that's gone from here. And I think that you know, we've seen Ursula von der Leyen literally flip around on so many different things, it's becoming a joke. And at no point do they actually sit down and actually say anything that, okay, we've got it wrong, apart from the person who's leaving the whole situation in a few weeks, months, is Merkel, who said that she took full responsibility for possibly making a wrong decision, which we'll talk about later. But these threatening of export bans and all the rest of it is just deflecting from the point that they have been slow and unable to react in a crisis again. So that's my rant over on the EU, but I think that it has had an impact, and we have seen euro weakness, underperformance that we saw coming due to the fact that we've got the opposite going in the US. So the resultant impact, there was a real concern about a third lockdown. Now, some of these are going to take place, even though Merkel's sort of hinted that you know, that they're not going to lock down over Easter because that's just too much. But there are ramifications from this, and it has hit markets quite hard. I think that the news that they were going to lock down further, and don't forget, this isn't just Germany, this is France, Holland, everywhere, Belgium, that this third lockdown is actually creating some real problems out there. And I think risk assets have taken notice of this. So if you look at 75% of European countries as of the 11th of March saw rising cases. France talking about exponential increases. Italy shutting down over Easter. France reimposing lockdowns. Germany, emergency break over 5 days has been cancelled by Merkel due to not only political pressure, but also public opinion. And I just wonder that the public opinion has a political potential behind it with forthcoming elections coming in Germany. And again in France next year, elections coming up. How are these people going to be judged by the populace after this pretty appalling exercise that we've gone through? So I think that the frustration in there is building. I'm not sure it's going away, and we have seen some significant shifts in sentiment towards locking down, face mask wearing, and all the rest of it. But we have got an issue here that these lockdowns will delay recoveries and therefore possibly hurt the growth story or delay it maybe. So if we look here, we've got the Euro Stocks, which is the composite of the European stock markets across the board, from the DAX to the CAC. Blue chip stocks have risen pretty steadily. I mean, since the Pfizer announcement on the 8th of November, that's a pretty impressive bounce of 34%. The hope of the vaccine creating the stability that we need to get some solid growth in. That is in question in the EU still. And you can see that we've had this period of volatility at the top here where we have to ask ourselves some questions. You know, the travel shares, I mean, the travel and leisure shares have been hit hard again. They've gone back into a crisis trade mentality. People are saying, well, holidays, you cannot even book them. They're illegal in the UK. You can get a £5,000 fine for taking an early holiday. And stock markets have backed off their highs. And this is really interesting. I think a lot of this is because of this structure. Now, when we see the equity markets in the US, if we look at the sectors, we've seen the darling of equity markets recently has been the Russell, or the small cap. And look at its performance against the NASDAQ and the S&P. The Russell has seriously underperformed, down 7%, I think it was in 2.5 sessions or something. So the growth story is literally coming under the microscope, and there's a danger that markets have got ahead of themselves here. And we saw falling commodity prices as well. So what now for stocks? I mean, have we seen the highs for now? You know, we've seen lower US yields, which should be prompting some support in these stock markets, and yet we're seeing these slightly deeper corrections creeping in. With the Treasury yield now looking a long way away from 175 on the 10-year, 1.75%, as you can see on the chart there, we should be seeing the NASDAQ rising. It's falling today. We should be seeing stocks underpin. We should be seeing commodities higher. Commodities had a horrible day yesterday. I would think the bounce today is probably more to do with the supply chain issues with the ship stuck in the Suez Canal. That's going to hold up quite a lot of the supply chains. And it may be a short-lived bounce, but we have seen some real sell-offs in commodities as well. So we have to question whether the growth story got ahead of itself, or if you like, markets got ahead of the growth story. So could these lockdowns hurt the growth story? There is a danger it can. So if we get a delay to the recovery, and some of the US data I noticed has just started rolling over a little bit as well, that, you know, it took off after the recovery, after the vaccine stories. It was a good story, and Biden's stimulus as well helped, and there's talk of more. But between now and when we get the new stimulus, there is a danger that we see the growth story fall for a while, but that could actually end up being a great opportunity, because there is still a view that Biden may get his infrastructure spending, possibly some have thrown out a number of $3 trillion, which is just madness, but huge, could make a massive difference again, and we could be back up again. So I think, you know, we have got this situation though, that the fundamentals mean right now the flying, driving and social mobility structure of the recovery process in some areas particularly may be on hold. I think in the US that's slightly different, but what worries me is there's a lot of talk about third waves coming, even in the UK and the US, and I think we need to be really careful about this, because I think the markets were priced for perfection for this growth story to build. Commodity story was strong. You know, we backed it as well. There's some question marks over this now, and I think this is really important, that we need to be careful that we're in this gap where, you know, we could see a consolidation phase. If we look at oil, you know, what happens if we break these lows? Are we going to go back down again? You know, can we bounce from here and go back up towards $68 on crude? we're really in this sort of no man's land on a few of these. Copper's come off but bounced today. We've seen gold, silver, platinum, palladium. We've seen everything moving in tandem, sort of away from its highs. And I do worry that markets may need to sort of take some of the froth off themselves whilst we recalibrate. And then when we start getting more positive stories from Biden's spending plans, then I think we may start to move back up again. But this period, and particularly into the month quarter end, which we've got at the end of in the next few days, I think we could be in for some high volatility. So getting married to a position right now, I think is high risk. So growth hit, stronger dollar we've seen. Finally, euro started to sort of come off against the dollar, which I think fundamentally is structurally a sound view. I was surprised it didn't happen as soon as I thought it would, but here we are. It's not managed to bounce either today. So the dollar's actually holding up fairly well. We have seen a small rise in yields, but only to 1.64% today, even after a relatively poor 5-year auction. Big 7-year auction tomorrow that you need to be aware of. Numbers come out about 5 o'clock tomorrow London time. But we had new lows in popular commodity positions. We saw Aussie, which has got gold and copper obviously attached to it, fall pretty hard yesterday. Kiwi got hammered for different reasons. We saw a big sell-off in bond yields in New Zealand. They're linking housing to inflation, structural change there. Canada, obviously on the oil move, has taken a hit as well. New lows for sterling. UK PMI Prime Minister said UK wouldn't be immune to the third wave happening in the EU. He's taking scientific advice. He's probably right. But the inflation data out the UK this morning was shocking. Quite a big surprise down, to be honest. We don't usually see falls like that in CPI in 1 month. And I think that's what sort of kept sterling rather weak today. Problems with vaccination supply still hang out there, but as we're on air, I was just picking up a headline that was suggesting that maybe there's some consolidation between the EU and the UK about vaccination supply, but I don't think it's been written in stone yet. So big stories out there, still ongoing. Quarter end coming up. The chart on the chart you can see there was shown on Sunday night. The euro has broken down. Dollar index bounced nicely off that line, back up into a bit of a short-term uptrend. And then we look at the euro. That is a decent fall. So it's broken some short-term supports. It looks to this 118.12 could hold. It looks like a bit of a spike low, but we're not bouncing away from these lows at all in any sense of the. So I think the lows are vulnerable still. So if we do see a breakdown there, maybe 117.40, maybe 116, maybe even a bit lower, depending on the momentum in this. If we were to squeeze higher again, I would think I would be looking to sell this somewhere around 118 and a bit. On a fundamental structure, have to look at the charts. But I think if we do break above 119.90 at level, you probably don't want it anymore. But I do think there are some fundamental reasons why the euro underperformance could continue. And I think that there's a bit of a credibility issue for the EU leadership at the moment in the markets. And I think they're being punished for that slightly. But there again, the ECB would be very happy with a lower euro. So, that's the euro from here. I think it's a bit of a mixed bag. We've seen the move down we wanted to see. The possibilities of making more money out of that on the short from here are slightly more limited. But if we look at the forward-looking PMI data, where we saw the preliminaries today, which are really important for me, we've seen a step up in all of them. And so it does look as though businesses are beginning to see the recovery start to take hold. They're certainly far more optimistic. If we look at the composite, which is the balance between manufacturing and services on the left here, you can see the US way out in front still, but Germany's picked up significantly. So this move up in Germany is important because services were part of that as well. UK, very good numbers again, moving up the scale. France still disappointing down there. But if we strip out services, which I've done on the right here, this is the consumer fronting businesses. These are the shop. These are the companies that face the consumer, offer them goods. Now, we're still seeing some real weakness in France. It's not happening. Those lockdowns are going to keep this slow, which means the EU is going to be slow to recovery. Germany's just struggled back up into expansion, getting above that 50 level. But look at the UK. This is pre-opening. That's a very good number. There's a lot of online shopping going on here. The US still way out in front, but you know, these are good numbers from the UK, to be honest. And I'm not surprised Euro sterling came off a little bit on the back of this. And I still think that the elephant in the room here is that the EU leadership are struggling to deal with a crisis in front of them yet again. And that hasn't gone away, no matter what Merkel says about not locking down in over Easter because it's politically sensitive. She may be the week after, who knows? But again, the only adult in the room in the EU, as far as I'm concerned, is about to leave her post. So that's the PMI data. That's me for tonight. I think it's going to be a very interesting day tomorrow. I think it's going to be a very difficult week next week into quarter end. So just remember, we've highlighted that the risks are quite large for some fairly volatile moves. You need to look at your technicals. And on that, there's a really good presentation coming up from Richard, who I'm going to pass you over to now. Rich?
Great. Thanks very much, Mo. Very interesting and useful as always. Good evening, everybody. Hope you've had a great week so far. I thought tonight I would discuss divergence within indicators and the potential that such signals and such patterns can highlight the risk of reversal and a more extended retracement of the previous trend. Now, divergence is something that occurs fairly regularly, and you'll hear it mentioned quite often in various market reports and blogs and so on and so forth. But it's not necessarily always reported in what I believe in the correct way. In that, I mean, what is a divergence? A divergence is basically where price makes a new high or low, but that new extreme isn't confirmed by a similar upside or downside extreme within an indicator. Now, as I say, the majority of indicators when people talk of divergence tends to be momentum, but I'll just look at something this evening that can be quite useful in filtering out some of the false signals there. Now, basically, when people talk about a momentum divergence, it's thought that it offers a lack of confirmation and therefore questions the validity of the latest price movement, be it to the up or to the downside. So in other words, a lack of momentum, so momentum not confirming a new high, say, that's just seen in price, is effectively saying that the speed of the market move is less now than when we saw the previous high posted. So that is then viewed as a concern and a risk that potential could turn towards a reversal and a more extended correction. Now, as I say, momentum is the most common indicator basically highlighted to be showing a divergence. And this is mainly because it actually happens on a fairly regular basis. So you can quite often see divergences occur within momentum-based indicators. So RSIs, stochastics, slow or fast, whichever ones you're using, are momentum-based indicators, and they will often be quoted as highlighting divergence. But because of the nature of the calculation of momentum, it can often reflect false signals, and you need to be aware of this issue and how we can actually filter this type of signal within the momentum-based indicator to try and sort of avoid being caught by actually saying, well, we've got a divergence in momentum, the risk is that we're going to see a reversal, but then all prices do is see a very short-term correction and then continue to push to new highs, and momentum still sees a divergence. So we're going to look at a one way that we can try and avoid that type of signal. So this is a daily chart of the S&P, and effectively shows the uptrend that we were seeing through 2017 into early 2018. And underneath, we've got a 9-period RSI. And we're basically looking at this period here where prices were consistently making new highs seeing short-term corrections before buying support materialized and pushed the market on to new highs. So in other words, we were seeing a bullish trending condition. However, the problem with momentum and the RSI and the stochastic was very similar within this type of activity, was that we were seeing a consistent lack of confirmation of these new price highs by momentum. So in other words, we had divergence in place. And anyone that was looking at divergence and trying to highlight that as a turning point would effectively be very worried throughout this period, because the speed of market move was not as great as when we made the previous high. But you can see we consistently continued to push to new recovery highs with setbacks very limited and running into buying support very quickly. So the divergence risk reflected by momentum was a consistent false signal. So what I try and do is to actually have a confirmation indicator in place. And what I mean by that is that I will use a combination of the RSI or a momentum-based indicator together with a trending indicator. So I'll be looking at, so I normally look at the MACD. And it's not just the divergence that we see within momentum that's important, because we have to see confirmation of the divergence via the MACD as well. So you can see that while prices were consistently making new highs, momentum was failing to confirm, but the MACD made new recovery highs as prices did. And I'm particularly looking at this short-term period here, where obviously we saw clear divergences within momentum, but we saw consistent new highs within the MACD. So effectively, we failed to see trending confirming the lack of speed or market momentum as the price made new highs. So for me, I need to see both momentum and trending indicators failing to make a new high to really suggest that we're looking at a more significant reversal and the risk of a more extended decline. Now, the one thing that I need to stress and point out is that any divergence, whether it's just momentum on its own, just trending on its own, or the combination of the two, has to see confirmation from price action. So effectively, even though we were seeing this divergence, each time I would be looking for confirmation in terms of price action. Now, it would be beautiful if we could all say, well, these indicators haven't confirmed new highs in price. That means there's a divergence. The market's now going to sell off. Unfortunately, it's not that easy. We need to see confirmation from price. And by that, I mean we need to see a break of the last correction low within the recovery trade to confirm this divergence. Because as we can see, divergences can remain in place for a prolonged period of time. And really, we need to see further price activity to confirm that divergence. So even though you hear somebody starting to comment on the market saying, well, there's a divergence within price and indicators, it isn't an outright sell signal there and then. You have to see confirmation in terms of price action. Now, one of the reasons why I'm looking at divergences this week is that those of you that have joined us on the Sunday night webinar will know that I've been talking about the S&P, and this is actually the S&P up to date on a weekly basis. I've been highlighting the potential of a divergence within the various indicators, but in not just momentum on its own, but also trending. So in other words, as prices made new highs to test this extension level, so a natural resistance point to the current advance, prices made new highs but tested the resistance. But you'll notice that not only momentum, but also trending failed to confirm that new upside extreme in price by closing in new high ground. So this reflects the double divergence and obviously trending backing up the lack of momentum behind this move and the fact that we aren't seeing these new highs in price confirmed by momentum and trending. So not only the speed is less this time than when we made this previous high, but also the trending condition of the market is slowing and is slackening. And that is a concern when we see both momentum and trending with that type of backdrop. So not only have we seen this divergence of these highs, we've actually seen the S&P rallying and retesting this extension level. And you will notice that still, once again, momentum and trending are still below their previous peaks, reflecting the concern within the overall structure of this current move. So again, having attempted to push to new highs, we've failed at a resistance level, and we're still seeing momentum and trending failing to confirm those new highs. Now, we need to see confirmation. So effectively, this last correction low at 37.11 is the important resistance focus support level that we need to focus on, because basically we would need to see a break of that level to confirm this divergence and the risk of a more extended sell-off occurring. So while we're effectively highlighting the divergence, we don't yet have the confirmed failure in place, and that won't be evident until we see closes below 37.11 to trigger a more extended sell-off and to bring into play this divergence risk. So that's how I look at divergence, and I think it's very worthwhile bearing in mind, if you see just a momentum indicator failing to confirm new highs, just look at the trending condition as well. If that's confirming the new price extreme, then it ignores the momentum signal, and the risks are that we can continue to push to new highs. Okay, so for the last few minutes, I just want to flip to the live trading platform, if I can, Chris, and just look at a couple of charts that I think are quite interesting and at the moment in terms of price action and the shape of price action that we're seeing at the moment. Now, any of you that know traditional technical analysis would have heard of the head and shoulders top. Now, the head and shoulders is basically a negative reversal, which reflects price action having made a new high. The market corrects, just appears to be a normal correction within an upside move. The market then rallies, having found support, makes new highs, fails, corrects, falls back towards this previous low, and then the recovery, which you would normally expect if this is a bullish trend, to continue to push to new highs. However, what we actually see is a failure of that upside strength, so a lack of commitment pushing to new highs, followed by a break of the trend line connecting the recent lows. So we've got the left-hand shoulder, the head, the right-hand shoulder. Now this is a chart of Aussie versus the US dollar on a daily basis. So effectively what this is highlighting is quite an important negative sentiment shift for the Aussie, positive for the US dollar, and that highlights the risk of a more extended retracement of what has been a very strong period of Aussie outperformance since the March 2020 lows. And effectively just a normal 38% retracement can see us back towards 70.50. So the height of the pattern projected downwards together with this support level and these previous lows, it's not inconceivable to really look for further US dollar strength to see Aussie US back towards the 70.50 type region. Similar sort of pattern evident within the Kiwi dollar versus the US dollar, but because of the negative backdrop that we saw for the New Zealand dollar yesterday, as Mo was talking about earlier with the move in Kiwi yields, we saw the break of and completion of this head and shoulders top much earlier within the Kiwi than the Aussie dollar. But both are confirming quite an important sentiment shift and risk for further dollar strength developing to see a more extended retracement of this move. And as I say, the first retracement level is around about the 67 cents area. So effectively, that is a potential support level within any more extended sell-off. Now, just finally, what I wanted to look at was the Aussie yen. We've seen quite an important shift in the yen this week. As we've started to see yields moving, we've started to see the yen appreciating, and this seems to be sort of reflecting more positive themes for the yen. Now, obviously, I've been highlighting for some time this bullish uptrend within Aussie versus the yen, but you can see that the breaks below that uptrend have now materialized, and the risks are that this could see a more serious and extended retracement than anything we've seen since October last year, to see a sell-off towards at least the 38% retracement level. So the fact that we've seen this uptrend give way does tend to suggest that the Aussie can weaken, which we've also seen against the US dollar, but also the yen strength is beginning to materialize, and that this now suggests the breaking of this uptrend reflects a more important sentiment shift and at least a correction towards what has been an extended move higher over a pretty prolonged period of time, or underperformance for the yen for a prolonged period of time. And we're going to see some sort of rebalancing of that move. So I think this week is very interesting. Potentially it's seeing some very important turning points for markets, the US dollar in particular, the yen, Aussie and Kiwi, and the euro on top of that as well. So the risks are still towards US dollar strength, and technicals still seem to be backing up that position. So that's the technical backdrop at the moment. It just now leaves me to hand over to Roger, who's going to talk about a very important aspect of trading, and that's when markets move against you. Thanks very much, Roger.
Thanks, Richard, and Mo prior to that, and good evening, everybody. Yeah, so one of the key elements, and I'm very pleased that we've actually been asked to talk about the downsides of trading, as you will, by various people actually, and certainly some of the individuals that are logging on to the webinars. It's a key factor in your success of trading, is to be able to manage the downside of trading when markets go against you. Using all the tools and making sure you're keeping to your disciplines, and knocking into that, obviously there can be some psychological barriers that you need to get through to be able to survive these markets and be making money in the future. So we're just going to run through how we would look at handling our losses. Clearly, we all make them. We will make them. It's a big market out there, and our ideas can't be right all the time. So, that, as easy as it sounds, is one of the most fundamental things for us all to be able to do, and that is to accept the fact that it is an inevitability. Strong words. We will make losses. Our ideas, our timing can go awry at times. Sometimes we can be in the wrong product. All those kind of things can conspire against us, and we will make losses. And I do go on to a little analogy of listening to a webinar of a professional sports coach, and basically he was talking about one of the top motorcyclists and how that person handles risk and danger. And similarly, whilst it's a completely different type of risk and danger, we do face those in trading. And that concept of this guy on a bike angled at 45 degrees to the floor going around a corner at 200 mile an hour, and the back end starts twitching. How does he handle that situation? And they say that the most important thing is to accept that you are in danger. And once you accept that fact, your instincts kick in. All the things that you've learned on how to stay on that bike, how to handle the back end sliding, they just kick into gear. And really, the whole thing is all around accepting I'm in danger. If you fight against it, you're going to end up in the sand. You're going to end up sliding through the shingle and hitting the tire wall. But if you understand and accept that you're in danger, you can kick in and do something about it. So, a very, very key thing for us there, accept the fact that we're going to make losses. So we've got an S&P chart here, 5-minute chart, and we're just going to run through, a potential quick trade. We decided we want to buy the S&P. Our buy entry level is at 39.13, It's just above the recent low at 39.09. And in keeping with our short-term trading, as we are in this situation, we wanted a fairly tight stop. So, we stick a stop loss down now, 3,900, which is our stop loss protection. Why would we put it there? Because we would have looked back and there'll be some form of resistance or previous high that we've broken through that will give us justification that that's a fairly key level, and therefore it's a good level for us to be basing our protection around. So we get into that situation where we carry on trading, and wow, happy days, it's moved straight in our favor. We're moving up to a high of 39.34. At this point, we're making all sorts of decisions. We're gauging the market, the speed of the market, price action, if you like. And we'll also have had our targets in mind. If I look at that 39.34, what have I got there? I've got a 21 pip profit there. And I was willing to lose 13 pips from 39.13 down to 00 if I was stop lossed out. I've kind of got nearly a 2-to-1 positive risk reward. Everything seems good for me at the moment, but I might be looking at other targets, and I let the trade play out. And as we play out here, we get a bit more extended sideways action, and bang, we go down and we take a hit. We go through our stop loss level. Smiley face turns to a fairly glum face, but again, let's not be too glum. We have accepted we will make losses. This one is disappointed because we were in a profit, yeah? But then we have to start looking at, did I have a plan around my trade? And if I did, was I just unlucky? Did I just miss my stop loss? If I'd have been watching this and trading, my stop loss maybe would have been up at 39.45. Who knows where we would have targeted? I've just missed it, so I didn't take my profit. Could I have used trailing stops? Those kind of things that we've spoken about in the past. Of course, but let's say we had that plan and we made these decisions not to. We've gone down and we've taken our hit. It's a 13-point loss to our bottom line, but mentally, it's a 34-point loss from that high. Yes, it hurts, but we had a plan, hopefully, and unfortunately, this one went wrong. Was it a good loss? Well, we have to ask ourselves that question. And here's one of the key ways of getting through this whole thing about handling your losses. Evaluate that trade. Use a diary, put in those quick facts as to why you went in at that level, why your stop loss was where it was, what your targets were. And as we say, the process that we always talk about, that process that should underpin your trading and give your trading stability, helps get you through this bad time. So you talk about how could you have improved on that trade? And again, I stress the fact this is not a long post-mortem. Try be honest and constructive. It should be relatively quick. The longer you've been doing this, the quicker it will be. I always ask my traders, when you had a bad day, go home, quickly look in the mirror, and if you can honestly say to yourself that despite your losses, you did your best to minimize those losses, you weren't lazy. One of the bad things or worst things about bad traders is that when it all goes wrong, they stick their head in the sand. They don't have the answers. As long as you had a plan, as long as you had some answers, you have to accept that you've made a loss. As long as at the end of that day, you can say, I minimize that loss to the best of my ability. That can be a short conversation, and you can end that conversation despite a loss on a positive note. And I've put a little example there of that very quick conversation with yourself. It was a good trade idea. Possibly I could have been in FX instead of equities. Maybe I was too eager and put too much risk on to start with. Did I get greedy? Ask yourself some of those tough questions as well. Was 45 too much if my target was there? And then, was my stop loss in the correct place? And in this instance, you stop yourself out. You've taken your 13-point loss. You've minimized your losses on a trade that ended up going wrong. Could you have taken profit and come out? Of course, but that's why you ask yourself those questions. You ask yourself those questions in a positive tone, and you come out, as we'll see on the next slide, and play this out with a positive tone. You know, don't beat yourself up too hard, because this hopefully is just a one-off, you know, and as we've often said, you know, out of 10 trades, if you do this and analyze it and you've taken short, small hits on these ones that go wrong, and you ride the ones that go right, maybe effectively using trailing stops, etc., you don't have to get 7, 8 out of 10 trades right. You can be 4, 5 and still make good profit as long as you manage these losses. You know, there will be these anomalies. Don't fall to peer pressure as well. If you're hearing about other people that are doing really, really well, you know, make sure you've got a plan that applies to the trade that you're in, the type of trade you're in. Respect that market, because it will go wrong, but don't be afraid of it. You know, take these losses and move on. One of the big benefits that I'll just go through quickly here, and again, this really is from a psychological perspective. In this example, we'll play the market out, and look, it goes bouncing back up again. If you've done your analysis, if you still thought it was a good trade idea and maybe you got a bit unlucky, if maybe you learned you could have put some trailing stops in to protect a profit as such, but you still were disciplined and stuck to that tight stop loss, you come out of that conversation with yourself in a positive manner. You then go searching for your next trade. Your mind is clear. You've only got a small loss to worry about, and you potentially still like that trade idea of buying, and you may have that opportunity to get back into that marketplace and start recouping some of your money. And as you see there, it moves up in your favor. You could potentially learn from you know, your previous trade, and at that point you may start applying trailing stops. So it's all this process that if you stick to it, but you make it fairly short, fairly positive, that allows you an opportunity to go back into this trade. And I'll just give you another reason why psychologically lots of traders that do stick their head in the sand go wrong, is because what happens is it moves up to 39.34. They get greedy. They want more. It starts sliding away. As it gets lower and lower, they get angrier. They now start thinking, I've lost 34 points. You may have lost it from the highs, but physically you're only going to take a 13 pip loss. Yeah. What they do then is they get angry and they move that stop loss. It's the fear of taking a loss, so they move it lower. Now, I guarantee you, when you see some of those nasty spikes down after we've taken our loss, there's a bad dip down, the red candlestick, there's a rally up that stalls again just by our stop loss, and then again a bit of a doji pattern there. You're ignorant to that doji pattern because you're angry by now, and then you see another couple of nasty spikes down. I guarantee you those type of traders are the ones stopping out at 38.85. Yeah, they've taken another 15-point loss. They're stopping themselves out at a random number. It's not looked at as a chart number. That probably would have been down at 38.75. They've stopped themselves out for all the wrong reasons. The knock-on impact of that is that they're so angry they can't see the wood from the trees, and they then miss that new buying entry or buying opportunity to start clawing some money back. So there's some of the psychological reasons why we like you to stay disciplined, have that little chat with yourself, and hopefully open up some new opportunities going forward. And I got one quick slide here just to talk you through, you know, when you're handling heavier losses or a series of losses, when it all feels like it's going wrong, my only advice and the best advice to give you is what I would classify as decompression. Literally, that's reducing pressure. It's important to take time out of the market after these losses, and as we've seen there, you know, be with the family, you know, when we can get out on a golf course or just get on a bike, get some fresh air, just to free your mind up. You'll still be thinking about FX or equities, but hopefully you're doing it and decompressing, and your mind starts clearing those bad thoughts, so that you get that time where you press the reset and you think, right, I need to get back on that bicycle. One, because I enjoy it, and hopefully that's the main reason you're trading. You enjoy it. You feel you can take a little bit of money out of the marketplace. And you do need to get back on that bicycle. What gets you back on that bicycle and what will make you successful going forward? Sticking to the process. You know, you will have built a formula up that would help you make money in the past. You've just gone through a bad cycle, whether it be bad timing or you're just not quite reading the market right. When you feel it's the right time, get back on that bicycle, look at your process again, maybe look at your diary to see how some of those trades had gone wrong, and then start revisiting the marketplace, do a bit more reading, get back into sync with the market, find your next trade idea, and then work through that process again. And, you know, whilst it's quite simplistic, it's the most important thing to do, is to take some time out, reset. When you do come out of that, the one thing I will suggest, your confidence will be low. You're going to start down the bottom end of that confidence ladder, and therefore the amount of capital you put in the market, i.e. the amount of risk you put into the market, should actually relate to that. So start at the lower end there, start with smaller amounts, get your confidence back in, and start building up to maybe where you were trading at before. So hopefully that'll help. You know, as I say, we will all make losses, it's inevitable, but hopefully by sticking to some of these processes, you know, you'll have a much longer run of winning trades, and your bank balance will grow. So after that, back to Chris for some questions.
Thank you, Roger. Thanks to Maurice and Richard as well. Some great stuff there as well. One thing before we go on to questions, just want to remind everyone, invites go out tomorrow. The Sunday night that all the mentors were talking about, that's back this Sunday, the 28th at 7 p.m. Invites go out tomorrow, so we'd love to have you all attend. We had a record attendance last week, so it'd be great if we could have as many people as possible again this week. Lots more to talk about as we go in, as Maurice said, I think, as we're going into month end as well next week. So first question for you, Richard, can you suggest any particular setting for the MACD? Is there any max or minimum like the RSI have that exists for the MACD?
Yeah, I mean, the settings that I use are 10 and 20 and a 9-period moving average of the indicator line itself. I just find that they give me the more reliable signals that I'm looking for. In terms of a minimum and maximum, the momentum or the RSI that was mentioned was the calculation basically means that it ranges between 0 and 100, and effectively that means that it can't go out of that range. So there is effectively an overbought reading, whatever that level, 70, 80, or even 90 in some cases may be. With the MACD, because it's measuring the gap between two moving averages, in theory, that gap can become as large and continue to grow. So there isn't any sort of outright levels that you can talk about to say, well, we're now at an overbought reading, and the risk is that we can see a setback developing. So that gap can increase. So the level of the MACD can continue to go to extremes. What you may find is that if you look back historically at one particular asset, you may find that there's a reasonable consistent level for that particular asset within the MACD that highlights upside and downside extremes, but you know it's not a sort of a definite number like we have with some of the other indicators. It's more the cross of the indicator line below it or above its moving average that gives you that signal.
Okay, thank you very much. Roger, one for you, and you may not have the answer to this, but maybe do you have any ideas about a good books that someone can read on trading psychology, or if somebody wanted to go maybe to the next step and read a bit more about it, where would you suggest that they could go?
The difficulty I found, you know, and a lot of, well, virtually all of we do comes from our experiences in the marketplace, and you know, I genuinely feel that's the best way to pass on coping mechanisms as such, with your trading. My problem was, as soon as you start looking into psychology of trading, and you know, there's a guy called Norman Nicholson who was one of the top guys at LSE. And the problem is they get deep into psychobabble, you know, and you'll be reading reams of paper on cognitive bias, and they're trying to explain why things happen as opposed to how to handle them. So, you know, I think it's quite difficult to find a practical book that relates to your ability to handle situations, not just in trading but in life. You know, when emotions start kicking in, because you know they spend a lot of the book trying to explain why this is happening, and you know, going into those kind of behavior patterns as such. So you know, he was a lovely guy. I met him. Norman Nicholson, his name, but you will have to cope with a lot of lingo as such.
Sounds like a gap in the market for you to write one then, Rog.
So one thing that I know that you've been pointing out, or has been pointed out on some of the chats and some of the news things, Morris, is that I believe there's a press conference from Biden. Is that tomorrow? Is there any potential that you might talk about that stimulus that you've been going on about, you know, on the webinars and also on the Sunday night as well, the infrastructure stimulus? Is there any chance you might outline that?
Yeah, I think, look, he might allude to it. I'm not sure that they've got the full plan in place today, because I think what they've got to do is they've got to go and talk to the Democrats and the Republicans, and say, look, you know, we want to do this, that, and the other. And the Democrats, you know, seem to have a clear path of what they want to do, but the problem is the Republicans are scared witless that they're going to start using this as a Trojan horse to sort of push through some very strong socialist tax hikes. Yellen again was talking about 28% corporate tax going back. So I think it's a little bit early. I can't remember exactly what the title of his structure is going to be on this press conference tomorrow, but he could allude to it. I think he's probably still pretty nailed down with COVID, but they do seem to be coming through that. But yeah, any hint that he's getting there on, you know, there's been some leaks of some of the structure that he's looking to do. But I think realistically, for this to get formulated and put to a potential vote, I think it's probably going to be nearer a midsummer, but we may get some hints towards it, because I know he's very keen to keep this at the front of everybody's thought process.
If he was even to put out there about the size of the package, would that be enough to trigger a rally in the market, do you think?
I think it probably
if
would.
It was huge.
Yeah, I think someone flew a kite the other day about $3 trillion, which I think the Republicans almost choked on their breakfast. But you know, it is a huge amount of money. I mean, if he comes up with another 1.9 or 1.5, it's still a lot of money. But if you actually look at what he believes needs to be done, it has to be huge. Otherwise, it's going to be piecemeal. There is so much that needs doing in the US. And if they really want to embrace green credentials and push for renewable energy, the cost of that is actually astronomical. So a very large package is going to be needed, and he is very aware this is the only chance he's probably got to get it done. So if he can't get it done by midsummer, I don't think it's going to happen. So it's a really crucial time politically for Biden.
Okay, thanks very much. Someone was asking, Roger, is there a set, you talked about taking some time out. Is there a set time that you recommend you need to get away? Is it that if you've had a series of losses, maybe you needed a longer period of time out rather than when you've just had a bad one-off event like you showed on your on the slides?
I think in some respects it depends on your circumstances. You know, if you've been trading well, this is a little blot on the landscape, and you know everything else in your world is fine. You know, I think it can be it could be as short as a round of golf, to be honest. Just to get yourself some fresh air, chat to your mates about something completely different, and then go look at the market the next day. I think if you feel like something is fundamentally wrong, or you know there's other things going on in your life that maybe are detracting you from your trading and not helping you make the right decisions, then you know maybe you need to be honest and address some of those issues before you start getting back into trading. And you know that's life. You know we all live very complicated lives, and you know there's always a case where there's other priorities. So you know I think it will depend on your circumstances.
Okay, thanks very much. Richard, we saw some Morris point out on the charts about you know, he had about Euro stocks. It looks like they're still in the uptrend. Is there anything pointing a similar sort of divergence that you were showing for the S&P? Is that the similar sort of thing for the DAX, the Euro stocks, the CAC, etc.?
There isn't, as it stands at the moment. No, you know, we're still looking at the overall structure, and you know, the market has had a bit of a sell-off from the recent highs, and in fact, those latest highs, momentum didn't. On the DAX, that's the one that I particularly look at. Momentum didn't confirm the latest highs within the DAX, but the MACD did. So, you know, we've got one of these examples where momentum hasn't confirmed, so the speed of the market move is lessening, but the trending condition is still relatively strong. So that isn't, you know, there isn't the threat of the divergence in place. So it's more a matter of looking at price action, supports of mid-Bollinger Band averages and things like that, looking for reversal patterns rather than sort of highlighting the risk of a divergence similar to that as the S&P showing at the moment.
Okay, thanks very much. Question for you, Morris, and this will be the last one, unless anybody's got any others that they would like to put on the chat. Obviously, Boris Johnson has laid out, I mean, you know, he's getting ahead of the problem that potentially the UK may suffer from the lockdowns problems that the Europe are having. You know, sterling has reacted poorly in the last couple of days. Do you think this is more of an issue than maybe even markets suggest, or is that something slightly different?
I think it's a real danger, Chris. I think that, you know, the last time we saw an outbreak in Europe, it was 2 or 3 weeks before it came here again. And I think there are, listening to Chris Whitty and a few of the others, there's some very real concerns and quite an open belief that a third wave could come, particularly, you know, in about 3 or 4 weeks' time. And the point is, though, we are far better vaccinated than we were, and so whilst there may be cases, it could be amongst the young again, a lot of what's the word I'm looking for? A lot of people don't actually show any symptoms, asymptomatic. Thank you. And I think, you know, whilst cases may rise, I think the death rate is probably going to stay down, but a third wave could come. If it comes to an extent that we have to lock down, that will hit the economy, and it will hit sterling and the markets, I think. But I think we need to be prepared for it. It depends on exactly what kind of impact it has. The difference in Europe is they haven't got the vaccinations out there, and I think that's a massive difference between the two. But there is a real danger that it is coming, and it'd be interesting to see in what form and how we, you know, the vaccinations we've had so far have dealt with it. And remember that the young are more you know, asymptomatic than the older people. So whilst they get it and carry it, they don't actually suffer from it. So it's going to be a slightly different dynamic, but I do think there is a danger that a third wave could hit, and we should know more about that in 3 weeks' time, just as we're unlocking probably.
It's just at the start of that growth spurt, it's sort of hit just at the wrong time, because the PMIs show a lot of optimism, and that's a good thing, but it's just whether or not that optimism is followed through on.
Well, this is true. I mean, these are survey data. People do have an opinion and it is their sort of optimistic view, if you like, but it is based on sound businesses picking up. But yeah, it's a risk, but I do think we're better prepared for it than Europe.
Brilliant. Okay, we'll leave it there. Thank you very much for everybody who attended. Thank you to the mentors. We hope to speak to you again on Sunday night. If not, we'll see you in 2 weeks' time. All the best. Have a great time trading out there.